So today we're going to spend a bit of time breaking down some of the costs associated with buying and owning property. Taxes are a very big part of that. A lot of people account for the upfront costs, but I know land tax is also a very big topic that we're going to spend a bit of time on later on in the episode. But to start off with, the main cost associated with purchasing a property in Australia is stamp duty.
Absolutely.
Yes. So maybe just a brief explanation of stamp duty and why it exists and how it's calculated.
Yep. Okay. So stamp duty is a state-based, state and territory-based tax, which is all the rates are about the same. They all sit around that 5% plus or minus amounts. So it is an important factor to consider when you're purchasing a property. It is a capital cost for the property. So eventually, when you do sell the property, and calculating capital gains, that'll basically come off that at the end of the calculation to help you pay a lower tax bill, which is good.
Yes. So it is deductible, because that's a big question I get.
So it's deductible against the eventual capital gain. So in tax land we call it capital, but at the end of the day it is deductible. Some of the main factors when considering stamp duty is is whether you are buying the property with a foreigner, as we call it. So basically, if you have a spouse who's not an Australian citizen, not an Australian PR, that's where you do need to be very careful and take advice to ensure that you don't trip up a foreigner foreigner stamp duty levy as well.
Yes. Yeah, no, it's a very common scenario for a lot of our clients. We have a lot that one spouse is Australian and the other is non-Australian. And there's quite a few of them that even if you have PR, you're not always eligible for the foreign buyer stamp duty exemption depending on the state that you're purchasing in. So it's just very important that clients get advice from their conveyancer before they purchase.
Absolutely, and the one of the reasons why I like working with you so much, Tim, is you're always very careful with the loan structuring and to make sure that we're not sort of bending backwards to satisfy the bank's conditions when the client's personal conditions might be disadvantaged if they do have a foreigner on the title.
Depending on the bank, this is where it's part of what we know is that there's banks that discriminate against you as a citizen versus a PR holder overseas versus being a non-PR holder as well, but there's solutions for every scenario, so it's part of what we do every day. There's always an option, you just got to find it. So
yes, and sadly when it comes to stamp duty, there's no way to get out of it basically. So a lot of clients will ask me, can I set it up in a trust or a company and get our stamp duty? And the answer is no.
Trust companies, we'll have a whole other episode on that. It's again, a very common question I get, but a whole other ball game. I know we've talked about stamp duty being one of the upfront costs and it being deductible. What are some of the other upfront costs that people need to account for?
So the other typical upfront costs, so lawyers' fees, so that's obviously a big one and an obvious one. You also have inspection fees as well. So basically getting the house checked over by a building inspector, and they can add up. Buyer's agents as well. So a lot of clients do like to use buyer's agents now. So that's buyer's agency cost is also a capital cost. So that'll be deducted against your eventual capital gain. And then you've got, for example, some of the costs like travel costs. So that's something that clients do have to be mentally prepared for. It's not really a tax question, but mentally prepared for is to spend money flying down to Australia. And remember, just because you're flying down to Australia to look at a property doesn't mean you're going to like it or doesn't mean you're going to win an auction. So make sure you buffer your travel budget to fly down multiple times and set your expectations from the start.
Definitely. So the other big tax that people need to account for is land tax.
Land tax.
It's a big topic. It's a topic that people often don't think about until they've already purchased a property and then they get an invoice in the mail or email saying that they owe the government some money. So maybe break down land tax first and what it is, and then we can maybe go into some of the specifics for each state.
That's thank you. And this is a big question that I have to deal with on a regular basis as well. Land tax. So land tax, it's important to remember that it is a state-based tax. Each state is different as well, which keeps it even more exciting. And it's a tax that is levied on one day of the year. So effectively, each state and territory is looking at your position on that day of the year, and that's your position on that day determines whether you subject to the full 12 months worth of land tax. There's no pro rata as well. So the only situation that you'll get a pro rata land tax is when you're buying or selling a property, and that gets prorated in the settlement statements by the lawyers. So it's effectively a manual pro rata. But basically, if we're looking at land tax, let me talk about Victoria. So I'm a Victorian. So Victoria has a tax-free threshold. And at the moment, it's just been reduced to 50,000, which is quite a low threshold.
Lowest in the country.
Lowest in the country, yes. And basically what that means is if you hold land that it has a value of $50,000 or more, then you'll be subject to land tax on the value of the land above that. Now, it's also important to remember it's just the land, not the market valuation of the property. So, for example, with my property in Melbourne, I have a considerable land holding on that, unfortunately, so I get a considerable land tax bill on that. But thank goodness it's not on the valuation of my property. It's just on the land valuation. And another question we get a lot is clients wanting to challenge the valuations as well, which is a difficult process, and that's one that you need to take up directly with the Office of State Revenue that you're dealing with, because generally they will use local area valuation experts that will value the property probably once every 2 years.
So that valuation process is separate from your rates notices that are done by council, is that right?
Sometimes it's linked,
Yeah.
but sometimes it's separate as well. But
Okay.
so sometimes you'll be looking at the State Revenue Office will be using the same valuation for both purposes. Other times they'll be using different. So this is where we have to take a different approach for each state and territory, unfortunately. But slight silver lining, always silver lining when it comes to tax, is land tax is deductible.
Yes, that was going to be my next question. So when you're doing a tax return every year, it is a deductible expense against any rental income that you've earned
Correct.
on the property.
Yeah, correct. And we probably should talk about the principal place of residence exemption for land tax purposes as well,
Yes.
because this is another question that comes up. So generally when you purchase a property, sometimes your lawyer as a default position will elect that your property is a principal place of residence, even when you're living offshore. So that's an important factor to check the paperwork. Now, if you advise the State Revenue Office it's a principal place of residence, they're not going to check on that straight away. So, and this is where the scary land tax bills do pop up. So, effectively, you buy the property, it gets elected that it's your primary residence, even though you're living offshore. Several years later, you get a nasty letter in the mail from the State Revenue Office saying, "Are you renting this property?" And normally the answer is yes. And then as a result, you'll get back years of land tax, up to 5 years.
Which can be significant.
Can be very significant.
Yes.
Can claim a tax deduction for it, but cash flowing 5 years worth of land tax is pretty horrible.
Yes, especially in places like Victoria now where the thresholds are much lower.
Absolutely.
Yes.
Absolutely. And to add fuel to the fire, we also have the absentee land tax surcharge as well. So each state have their own absentee provisions. Some states are less aggressive than others. Some states don't even have it, to be honest. But the main states that have the absentee provisions is Victoria, New South Wales and Queensland, the big states. And effectively, the definition of being an absentee is slightly different in each state as well, so that's important to remember.
Yes.
New South Wales being the harshest at the moment. So in New South Wales, if you're a permanent resident of Australia, but you're living offshore, and you haven't been in the country for 200 days, I think it is,
Yes.
you'll be subject to the absentee surcharge, which is recently gone up to 4%, and that's on the market valuation of the property, not
And
the land
that's on top
value.
of the nominal rate of land
Correct,
tax.
correct.
Yeah.
So it's a pretty large disincentive to own a property as a non-resident if you are a PR or a non-citizen.
Yes. New South Wales in particular is very harsh to PR holders living overseas compared to other states.
Absolutely.
Both in acquisition of property and then the ongoing taxes
Absolutely.
they apply against it too.
But they've got the harbour, I guess.
Yeah. As long as you've got a good view. That's
Yes,
all that matters.
exactly. Yeah.
Maybe we can just quickly break down what are the threshold. I mean, the three major markets are Queensland, New South Wales, and Victoria. So, what do the threshold differences look like between each state?
So, Victoria, the threshold is 50,000, and that applies to both absentees and and ordinary citizens like myself,
Yes.
who's a Victorian property owner.
I will just note before, because you said it's calculated on land, it does also it does also incorporate apartment holders
It
in
does.
Melbourne. So,
Yeah.
based on the land holding of that unit block against the amount of units, they can also be receiving. I just got a land tax notice for my
Yes.
small apartment in South Yarra
Yes, yes.
for the first time.
No one is
So,
safe.
No.
No, exactly. So,
So that's Victoria. How about for New South Wales and Queensland?
okay, so New South Wales is $1,075,000.
Okay, so much higher.
Much higher, and that probably is in respect to the significant land value of properties in New South Wales. I think it's always a bit of a joke on you get this tiny little house and it's worth millions, and the New South Wales government know that as well.
Yes.
It's also important, I should note, that land tax is accumulative on all the properties you own in that state. So including if you own some jointly with your spouse and some directly as in your own name, you'll get two different land tax bills in that situation. So
Okay.
the government isn't missing out on any land tax opportunities.
No.
Yes.
And for Queensland?
For Queensland, so Queensland, your hometown or your
Yes.
home state. So for Queensland, a lot more generous than Victoria. So 600,000 for non-absentee owners.
Victoria also introduced recently a vacancy tax for properties that are left unoccupied. How does that work?
Yeah, so the vacancy tax is based on having a property which is anywhere in Victoria that's empty. So in the situation where you have a property that you're holding for the future and you're not renting it out, and this might be more targeted at some foreign investors who do like to purchase properties and keep them vacant, because Victoria has a large issue with housing availability. So as a result, they'll penalise you without that. So it is another form of land tax that will be levied. It is deductible, but to be honest, most of my clients, when they find this out, they start renting out their property real quick.
Yeah. It can only be deductible if they're earning income on the property though, is that right?
Correct.
So yeah, if they're not earning income and getting charged the tax, there's nothing to deduct.
There's nothing to deduct. It does become a capital cost against the eventual capital gain, but it's very little benefit to be realised now. It's more just a cash outflow.
What's the minimum period that has to be vacant for before it attracts the additional tax?
It's 6 months and a 12-month period.
Yeah, okay.
Yep.
Cool. Not a fun topic, but non-payment of land tax. What potential penalties are people looking at?
Yeah,
if they miss payment, or is there some grace in being late on these payments, or do they get pretty narky?
Look, it's each state and territory is a little bit different. We've obviously had some pretty good concessions during the COVID period, with most states and territory giving people a little bit of leverage, but generally you're up for a fairly hefty general interest charge on late payments. So it's important to just be aware of when your land tax state is. So for example, you've got in Victoria, it's land tax is levied at 31 midnight. So as you're having a drink and celebrating New Year's Eve, State Revenue Office is also rubbing their hands together. Same with New South Wales State Revenue Office as well. That's 31 December, and Queensland is 30 June. And generally, once you pass a land tax date, you generally will have a land tax bill within a few months after the end of the financial end of that cut-off period. Which then gives you generally a couple of months to pay. There are options to take payment plans as well for a lot of the land tax options, but just watch that general interest charge, because it can be hefty.
And just to reconfirm, like, land tax it's a state-based tax, right? So if you have properties in Queensland, in New South Wales, and Victoria, they are individually assessed in each state. They're not put together for calculation purposes.
Correct. Yeah, absolutely. So that was a provision that Queensland did threaten to do that, and it got overturned very quickly. So it's absolutely state-by-state based rule. And there's only, believe it or not, Tim, there's only one state or territory that doesn't charge a land tax. Do you know which one that is?
Is it ACT?
No, it's Northern Territory.
Ah, okay.
Yes,
there you go.
exactly. So sadly, ACT do charge a land tax, and they do it 4 times a year, not once. So even worse.
They need the money.
Yes, they do. They do.
A lot of these taxes sound very scary. They sound like a lot of costs associated with owning property. I think the main thing to remember, though, is that all of these taxes are deductible for tax purposes. So yes, there are costs that's incurred, but at least there is some tax benefits given to you. Especially, I think the main takeaway I've got is if you've got the property, you should make it an investment property.
Yeah.
Went overseas and earn some income on it
Agreed.
rather than leave it vacant.
Yeah, agree. Like I guess my main advice to clients that are considering buying an investment property is we do a cash flow planner, and also have a look at the tax situation. So cash flow is important for, and obviously this is the sort of thing that you talk to them about as being a mortgage advisor.
Yes.
Is meeting the mortgage repayments, but also understanding what your potential rent inflows and outflows are, including land tax, interests, council rates, with a provision for repairs and maintenance. But we do get such things like depreciation as well, which is a nice little benefit that you can soften the blow a little bit. And then understanding the I guess the ongoing cost of maintaining a property from year to year.
Yeah. Depreciation schedules is another upfront cost that some clients debate on whether they should get or not. What's your view?
Okay, that's a good one actually. So depreciation, generally it makes sense. Just to put that out there, but there's a few caveats of having a depreciation schedule and whether it makes sense or not. So number one is the property built before or after 1987, because that's the date that was the year that depreciation was introduced. Or if it was an older property, has it had a major renovation after 1987, which a lot of the case for Sydney properties is, because there's quite a few old properties there, and you buy them and they're renovated. Some of the main concessions is you get to claim 2.5% on the construction cost, and that's a claim that's over 40 years, so that's quite worthwhile. And you also get to claim on things like if it's a brand new build, you get to claim basic depreciation on carpets, curtains, air conditioning, hot water services and the like. Depreciation is a non-cash tax benefit, so in the sense that we can claim it every year, but you do need a depreciation report provided by a registered quantity surveyor or depreciation specialist. There are plenty of them out there that will do it for you, and the cost of those reports ranges from $400 to $1,000 depending on who you're using. Is tax deductible. Also to remember, it is a temporary timing difference, so we claim it today, and eventually when we sell the property we have to add that back. But because of the concessions that you'll generally be entitled to when you sell the property, such as the partial 50% capital gains tax discount, principal place of residence exemption, and also basically saving yourself from the non-resident tax rates today, it generally makes sense to do it.
Definitely. I think maybe just to recap some of the points that we've raised today. So obviously upfront costs that people really need to be aware of. Stamp duty is probably number one. But then just accounting for conveyancing costs, buyer's agent costs, building and pest inspection reports, and then potentially depreciation schedules are probably the main costs to think about when purchasing.
Yeah, a little bit of travel too.
Yes, and then if you plan to go and see the property, then yes. Could buy them sight unseen like I have, and then hope they exist. And then land tax, again, the biggest thing that I tell clients is it's very state specific and the calculation methods vary quite a bit. So the best thing that they can do is get some advice and make sure that they plan for it before they purchase the property.
Absolutely. It needs to be in that cash flow planner.
Yes. Property in Australia, there's a reason people still buy it. It's despite all these taxes and surcharges, is over the long term it still does very well. But you have to go into the investment, I think, eyes wide open as well. And having specialists like you are the best thing that they can do to do that.
Thank you, Tim.
Thanks for your time.
No, thank you. Pleasure.